Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app.
How my mind works. It's 11 a.m. on the East Coast. That's Elizabeth Thomas. That's Dan Nathan. I'm G Swizzle. There was a movie many years ago with Nick Nolte, Jacqueline Bisset, and the great Robert Shaw. Any of you know what that movie was?
No, absolutely not.
The Deep. That is correct, Dan Nathan. You recall that I believe Louis Gossett Jr. was in that movie. Do you recall that?
I do. Let's see where he's going with this.
I'm just going to assume you're not talking to me.
Let's see where he's going.
I am speaking to you, Elizabeth. By the way, this is market call, as I mentioned. At the end, towards the end of the movie, as they were all looking, they needed to find something to validate the treasure. Louis Gossett was diving, and his head got bit off by what, Dan?
Dude, a shark. Spoiler alert.
No,
here,
not a shark. See, I thought you knew. His head was bit off by a rather large moray eel that was living in the reef. I mentioned that because both Elizabeth and Dan mentioned that my shirt is moraying.
Okay, by the way, there's Liz, a couple things here, because you sometimes live out near the ocean here. You know that
I'm there right now. Can't you tell by my hair?
Yes. Yesterday or the other day when we did a pod, you zhuzhed your hair. I'd never heard that expression before. Somebody emailed me or texted me about a zhuzh. How do you spell such thing? Really quickly on the deep. Okay. I forgot that it was a moray. I just at the summer camp I went to in Lake George. It was a rustic summer camp, YMCA camp. They had one of those old projectors, old projector with like this is before beta and all that sort of stuff. They had one movie. It was The Deep. So every year, if it rained, you know what I mean? They put us all in this lodge and we watched this one. I don't know how appropriate that was for like a 11-year-old.
No, there were a couple scenes, a little risque.
And that would be the Jacqueline Bisset. But the last thing I'll say, and then we'll move on to Liz, because she deserves the spotlight here. When you think about Robert Shaw, and I know he's one of your favorites, he had a certain part of the movie thing just cornered there a little bit, like the old pirate thing near the water. Isn't that true, guy?
No, he played
Jaws.
He was a very versatile actor. Obviously, he portrayed Quint in the movie Jaws. That was patterned after a gentleman named Frank Mundus, as Elizabeth knows, his boat out of Montauk, the Cricket. I can do this all day long, as you know, but that's not what we're tasked to do. But yes, Robert Shaw had a certain character he'd play. My favorite role of Robert Shaw, obviously Quint, but he was, if you recall in the movie The Sting, he was Doyle Lonigan.
Correct.
You're gonna remember it's Lonigan.
Are you focused on anything from the movie front here?
No, I'm feigning interest in this conversation.
Wow. Okay, Guy, why don't we get to something that Liz might be interested in?
Let's before we start with Elizabeth's work along with Mario, Rosie had an interesting piece out about sector rotation likely to favor the equal-weighted stock index. And listen, this is something that I know the three of us have been talking about. Rosie does extraordinarily thoughtful work, Dan, but I think this is something that, again, people have been waiting for a while. We have pointed out the math hundreds of times in terms of as much as people want to talk about rotation, it's not really happening in any way that's markedly tangible, but maybe we're at the start of something now.
Yeah, Liz, you and I were talking about this on the Risk Reversal pod the other day, and we're talking about different sectors that you're focused on. I mean, he is focused on the technology and communication services. Like, that's kind of weird. They kind of split up some of these big hyperscalers, and we're going to get to your note because you're talking about a lot of the spend here. But as you think about, all of a sudden we've seen a widening of the volatility bands right off the all-time highs in the S&P 500. It was the concentrated names that led to the downside. It's also yesterday, if you saw that reversal, right, intraday, it was also those names. How do you think about everything X that 44% in the markets there? Because again, if you're looking at it from a market cap weight situation, it's just forget the other 60 or 56. I can do math there. But on an equal weight basis, like, are you starting to focus a little bit more on equal weight after you've seen the market cap weight being heavily levered to those big names?
No, I guess is the short answer to that. I mentioned this, I think, on the pod on Monday. I think people are getting a little ahead of themselves on the smaller cap stuff. So here's the thing. If you're going to be pro equal weight, that means that you're bullish small caps, like full stop. You have to be, because that means you have to believe that the smaller cap names are going to pick up the slack and perform as well, if not better than some of the larger cap names. And if you look over history, small cap does not start outperforming large cap until you're pretty deep in a cutting cycle. That's usually because it's after a recession. You've had cuts because things have weakened so much, and small caps tend to rip coming out of a recession. So some of these calls about the rotation and small cap finally having their day, I don't believe it yet. And frankly, I don't believe entirely that the Fed is going to cut in September. Odds are still pretty high, but they've come down quite a bit since last week. And I don't remember who it was in the comments that said this last week. I was talking about the Fed, the rate cut probabilities, and the fact that I thought they were too high, and that we had even sniffed at the possibility of a 50 basis point cut. And I said, I didn't think that was going to happen. And somebody in the comments said something along the lines of, is Liz crazy or just that naive? And I don't look that crazy or naive now, because you've got some of the reality setting in that the data just isn't supporting that narrative. So I think markets getting really married to this idea of, okay, we're embarking on a cutting cycle and it's going to be aggressive and small caps are going to come back and all of this rotation is going to stick. I don't think that's going to happen. I do, however, think that this rotation, what's going on right now, because money is coming out of some of those big mega cap names, I think the rotation will persist for another week, couple weeks, maybe even until the Fed meeting. But the money is going to find its way somewhere else in the equity market. I don't think it's going to come out and go to cash. So some of this rotation that's happening under the surface, I think, has staying power for another 2 to 3 weeks.
All right, let's talk about the small caps before we get into some other things. It's a bizarre set of circumstances because we're not in a recession in terms of just the math. I think everybody agrees upon that. Yet we're appearing to be on the verge of a rate cut cycle, maybe for other reasons that are not entirely clear to me either. So where does that put the small caps here? To me, they're sort of in no man's land. I don't think you want to be in the midst of a downturn so you can get an inflection here in small caps, but we're not anywhere. We're nowhere.
Yeah. Well, I think there's a few things at play in small caps. First of all, just over the long term, the small cap playing field has just changed. Companies go public much later in their cycle. So there isn't that same growth from small to mid to large, and watching that success story happen over a number of years. The small cap space too, because we haven't had a recession. We haven't had those economic conditions that small caps tend to thrive in. Small caps do need the stimulation. They need the rate cut stimulation. They need the fiscal stimulus. They need to have a reason to start hiring more workers than they already have right now. You've got a labor market that's pretty stalled out, not in a good way or a bad way. It just isn't really moving right now. So small caps have not increased their production. They haven't increased the productivity of their workers enough to drive margins. And when you look at just the fundamentals, and this is where I think this makes sense, if stock markets traded purely on fundamentals, it would be measurable, and we could always know why a stock was up or why a stock was down, and we could probably measure it by cash flow analysis and you name it. But small cap earnings have just not been there as strongly as large cap earnings have, so there isn't as much enthusiasm around them. If we did go through a recession, and at some point in our lives we will again, if we did go through a recession, I think the same thing would happen on the other side, where small caps tend to lead their way out. The exception to that, if you think about the global financial crisis, the exception to that is if something not in small caps very markedly took us into that recession, like it did in the financial crisis, financials took us into the financial crisis, then those tend to lead their way out. So actually what we saw after the GFC was that mid caps led on the way out because it was a lot of financials at that time.
Guy, by the way, Liz is obviously in the global financial crisis camp. Sometimes Guy might refer to it as the great financial crisis. I have said funny, in the past, there's nothing great. There was nothing great about it.
No,
unless
but
you were
great,
short.
No, again,
great as a measure of magnitude.
I think Danny Porter and Vinny and Steve Eisman probably refer to it as the great financial crisis. But I think we would call it as the global. I want to go back to something that equal weight S&P, the RSP, because I think Carter was on the program a couple weeks ago talking about, so look at that right there. You can draw that horizontal line from that kind of prior high from late last year. And you see that it just has yet to break out. It is yet to confirm. There you go. The new highs that seemingly were made by the market cap weight for like a month straight. Now let's go to the diamond, the DIA. That's the ETF that tracks the Dow Jones Industrial Average. And again, this is 30 stocks. They're not market cap weight. They're price weighted. I think that's wrong there. Let's go to the DIA. That would be the ETF, and whatever. It doesn't matter if Stephen is impaling himself again. Let's move that over. So you see what's going on. Not confirm the new highs in the S&P 500. Now let's go to Walmart, guys. See what I'm going to do? I'm going to tie this all in together.
Nice
this is
job.
one of the biggest movers today. And Carter was also highlighting, I think, that Walmart has yet to confirm the new highs in the S&P 500. We were talking about it on the Fast Money program 2 nights ago. So, guy, let's just talk about, you have a company like Walmart. They miss on earnings. Okay, they do talk about how sales are up, but they're starting to see the earnings pinched by their inability to pass on, cost to the consumer. I think they're also super aware of the fact that if they start talking about raising prices, right, that they're going to get the ire of the White House. But they're also talking about how they're trying their best to keep grocery prices in check. And I think that's really important here. Now, Walmart is unique in their ability to try to do that. Stock getting hit here, hasn't confirmed the prior highs. Thoughts there?
Well, that's the problem. We didn't get through the February high, which I think was 105 and change. We ground back up to it. Obviously, today we're lower on the back of earnings, which I didn't think were a disaster. But to your point, I mean, they're clearly challenged. And, the administration, we look at this stuff with a magnifying glass, right? But what the administration will say is this is a company that will do $750 billion, $750 billion in revenues. They can afford to eat it. And for most people, when they hear numbers like that, they will assume that Walmart is making money hand over fist. And it's not that they're doing poorly, but as we all have come to understand, they work on razor thin margins. So I think the hope for Walmart is, in my opinion, that they're going to try to eat these tariffs, but they're going to try to offset it with hopefully production gains on the back of AI. And that's still sort of, I think, we can debate that whether or not that's going to come to fruition. But just extend it out past Walmart. All these companies are going to have to start making these same type of decisions. Do we want to incur the wrath of the administration, or we want to eat it ourselves and then incur the wrath of the stock market, or some sort of combination of all three? And I don't think anybody's come up with the answer yet, but it's not bullish for any of these companies, in my opinion.
Yeah, well, and if you think about Walmart, and this is not to say buy or sell Walmart at all right now, but if you think about Walmart, their entire proposition to their consumers is low prices. It's not to pass costs through. It's certainly not to raise prices. So they almost have no choice but to figure out how to eat it. So when you look at some of the other retailers, if you've got high-end retailers, Williams-Sonoma at some point this week, even the higher end discount retailers, right? I'd consider Target a little higher end discount retailer, maybe can get away with some cost pass through. But when your entire value prop to your customer is low prices and to keep it lower than competition, it's going to be really hard to pass that through.
By the way, you know who clearly watches your work, Elizabeth? Do you want to guess or not really? Well, besides most of the world, Beth Hammock. I don't know if you're familiar with her, but Jacob can throw this tweet up because she's basically just echoing what you've been saying, that the data does not suggest that a September rate cut is necessarily in the cards. And here you go. Hammock, with data now, wouldn't see case for September cut. And if I'm not mistaken, and I think she's from Cleveland, I don't at me if I'm wrong. She also worked at Goldman Sachs. So, this is somebody that's coming around to your thought process as well.
Yeah, I mean, there have been a number. Bostic spoke today and said only one cut this year. It's both sides of the mandate are under pressure, and that's indisputable. Now, this isn't to say that things are too hot. It isn't to say that they need to hike, but I think at all costs, they're trying to avoid the possibility that they would have to hike later if they cut too soon. So obviously tomorrow's speech is going to have major consequences for what people think about cuts. And just FYI, as we've been recording this show, the likelihood of a September cut has gone from 75% down to 71%.
Whoa.
So now it's not because of us. Let's not overplay our power. But there are more speakers coming out and talking about the fact that, look, it's not a done deal because the data doesn't tell us it's a done deal. And frankly, I think Powell would have to twist himself into a pretzel to say, we're cutting because things are weak. It's not really that weak. We had one jobs report that had bad revisions. If the next jobs report is positive, he's going to have a real hard time saying, here's why we're cutting rates. So, and I do think the other thing I'll say is this next cut or this next meeting will be determined by the labor market report that we get on September 5th. Thereafter, the following meetings will be determined by inflation. And if the Fed had to sit down and choose which one to pay more attention to, I think they're going to choose inflation.
Yeah. And that's what the minutes told us, right? That we saw the other day, which is a very different situation where we were a year ago prior to the Fed starting to cut and that 50 basis point cut that we got in September. But Guy, I just want to say one thing here. I don't know this Hammock. I don't know what she does. I don't know this
Merle. I don't know what he does. I don't know how he makes a living.
I've never.
Elizabeth, you know this or no?
No.
That's troubling.
No. It's but you get my point here. It's like, it's funny. We're starting to see these Fed folks just kind of crawl out of the woodwork here a little bit. And, I'll just say this. It's like, this Fed, is she a governor? Is she I don't know what
governor.
She is. This woman Cook, this woman Cook, who's being pressured, by the White House to resign. Listen, I feel for these people who are out there suggesting, if you're a Fed related to the U.S. Fed, and you are suggesting that they should not be cutting interest rates because you're on a list, man. I mean, like they're coming for you.
We talked about it last night.
We had her pegged as a dove, actually, so that it's a little confusing. And I will say, Mario's the one who said I kind of had her pegged as somebody who would vote for a cut. So it's confusing why this is happening that way.
Elizabeth, I'm sorry, Dan.
No,
and I'm sorry to our audience. I'm sorry to Timmy, Jacob, Bill, Stacey, Amanda, who's great, by the way.
She's doing great.
If I were to say to you, Elizabeth, as for you, Troy Donahue, do you know this?
No. I mean, it sounds more familiar than the other stuff you've mentioned today, but
if I were to sing that, if imagine me singing, as for you, Troy Donahue, I know what you want to do. It means nothing to you?
No. It's a nice rhyme, though, whoever Troy Donahue
is. It was actually a Stockard Channing in the movie Grease, if you recall that scene.
So I've seen Grease.
Of course you have. Now, but I only mention that because Troy Donahue portrayed Merle Johnson in the Godfather 2, the scene that Dan was just speaking about. Dan, back to you.
Okay. So you just mentioned Mario. We're going to get to the work that you and Mario do every week. Guy, if you want a preview of Liz's work, you can come here on Thursdays. But if you want it in your email inbox, you can go to SoFi.com/blog/in-on-the-money. All right. So Jacob, you're just kind of messing with us because this is not easy to do. And I would like to see the old slide that we had before you got this one tricked out, because I want to get my little saying right all in one app. So
you know what Jacob did here? We changed the artwork on the piece, and he's now used our artwork. So our marketing team loves Jacob right now. He did this the right way. This is all branded perfectly.
All right,
I think we leave it exactly how it is.
Let's take a second here, because Guy, I know that you are a very creative mind here. Okay,
I am very creative.
So a couple things that stick out
with Troy Donahue.
Yeah, a couple things that stick out to me right here is the swizzle thing. Okay, so URG swizzle, that M is a swizzle, no doubt about it. Yeah. So then they line up the H and the N, and then they line up the two E's. Is this way you would have gone with this guy, again, being a G Swizz and looking at a swizzle like that?
Well, okay, listen, I'm not going to, as the term, this is a t-shirt term, cast aspersions here, because people obviously worked extraordinarily hard on this, but I am one that likes symmetry. So when I see that M, it really just throws me for a bit of a loop. Like it makes me go, ooh.
Wait, Guy, you need to explain the t-shirt thing to Liz. She was on maternity leave.
Oh no, we're having t-shirts made.
Yeah, but why?
G Swizzle?
Well, we all have our little sayings. Like I'd say, I don't want to cast aspersions, or this is a static chart. Let's go, those types of things that we use often. And we thought if we were to make t-shirts out of them, we could get into the swag business.
What do you think?
Okay.
Liz, what is your most repeated little thing that you do? Like, so we'll start out, say, what's really interesting today about the markets? You know what I mean? Like that sort of thing.
I think I say, first of all. I think I overuse the phrase first.
Well, Liz Thomas, first of all, and I have that make no mistake about it. That's kind of one thing that I
have at it. People
have at it, but no, have at it is something that I am choosing to say. Okay. By the way, is just one of those little vocal crutches, if you will. All right. So let's get back to the markets here for a second. And so if you want to get Liz and Mario's work in your email box on Friday morning, Jacob, you will just go to the SoFi blog and you probably search for On the Money and you can have it. But there's another way you can get it. At the end of the program, we're going to show you how to do that. It's a very special way. So Liz, we've talked, I think on the pod earlier this week, we talked a little bit about the contribution of consumer spending for GDP. It's generally 70%. And we know Torsten Slot kind of note from Apollo out on that. And you said, hey, I'm looking at that this week. But the GDP effect of this CapEx spend by the hyperscalers is equaling in contribution to that of consumer spend. I just thought that was really interesting. So walk us through what you're looking at here, because this is something I think investors are really going to have to get their heads around, because if you do have weaker consumer spending, which leads to weaker CapEx by some of these companies that are spending tens of billions of dollars or hundreds of billions of dollars, which has been a huge contributor to GDP, we could find ourselves in a little bit of a witch's brew, Guy, which would also be on a t-shirt. Go ahead, Liz. Sorry.
Okay. So starting off with just basically, this is the lay of the land. We're looking at the growth rate of CapEx right now for the hyperscalers, and the hyperscalers being Amazon, Alphabet, Meta, and Microsoft. So part of the understanding this is just wrapping the data around it. I think everybody watching knows that there's been a lot of spending on AI. Every earnings season, we come into it, and all we really want to know is how much these companies are going to continue spending on AI. And that's what ends up moving the stock price. So the fear has been, as valuations have gone up, what if their spending slows down? Or what if the spending doesn't materialize in profits soon enough and they have to pull back? We're looking at just the growth rates here. And this, just because these are eye-popping numbers on an absolute basis, 2025 AI CapEx spending is expected to rise more than 50%. So this is just year over year from 2024. Now it's going to slow down in 2026, but still almost 20%. So this growth is expected to continue over time. Obviously, these projections could change on a dime if things turn the other direction. Next slide. The rest of these slides will kind of put it into perspective. Why do we care? Now, Guy, I think you're really going to like this chart.
I love this one. I saw it, railroads. I remember being a young lad and being shocked that we were spending 6% of our GDP of CapEx on railroads.
A young lad in the 1800s. Yeah. So this is infrastructure CapEx as a percent of GDP. Now we're just looking at eras, and we're considering the Industrial Revolution a major era. We're considering the dot-com bubble a major era. And then if AI turns into a major era, this is where we are. Amazingly, back when we were spending money on railroads, 6% of GDP, we pale in comparison to that. So all of the conversation about like, we're overspending, it's higher than it's ever been. When you try to level the playing field as a percent of GDP, it's really not, it doesn't look outrageous compared to this chart. It's actually a little higher than what was happening in the dot-com bubble, but still not totally outrageous. Next chart. This is a good one. We took railroads out of this one because it's hard to compare railroads with AI. It's just, it's a long time ago. I'm sure somebody can do it, but I can't. So we took railroads out of this one, and we're just looking at the dot-com bubble with AI as a comparison. You've got AI in magenta, dot-com in blue. This is annual spending, comparing them over sort of the same stretch of time. Now, understanding that AI spending is mostly a projection from here on out. So the magenta bars, as they're growing, those are projections, again, could change pretty quickly. This is interesting, though. I didn't expect it to be this different. So I expected that AI spending would be about neck and neck. We're actually running pretty hot on AI spending when we're comparing it to the dot-com bubble. So that is slightly concerning. And this is something that I think we have to pay attention to as investors.
All right, let me stop you there for a second. I agree with you. We have to pay attention to it. We've used the word whilst you were absent, the sanctity of the CapEx, meaning that is it written in stone? Is it a foregone conclusion that this money will be spent? And when I see something like this, how far it's outpacing what we saw during the dot-com, I mean, for me, that's somewhat concerning, because if things slow down in the way with which we all, well, at least I shouldn't say that we all, that I think they will, I think despite the fact that people say we have to be ahead in the AI game, the first thing they're going to start to look at is CapEx. Is that a reasonable way to think about this?
Absolutely. Yeah. I mean, so there are big differences between now and what happened in the dot-com bubble. The companies are more mature than what we were talking about in the dot-com era. There's more, they're in a better position of strength. And I talked about this in the column. They're in a better position of strength because, number one, they've got a number of different revenue streams. Many of these companies do. They are more mature in the sense that they've been around longer, they're established, the competitive moat is there, and they're in a healthy cash position, many of them. So they can afford to spend this right now. They basically what we would call internally finance their own growth, right? Rather than having to do it on a bunch of leverage. So they're in a better position than what was happening back then. However, if you go to the next slide, I think this is where you have to really think about what we're teetering on. So that CapEx spending, if it does continue, and if it is a foregone conclusion, I think the market has decided it is a foregone conclusion, and the optimism around this is on the premise that it is a foregone conclusion. When you look at what it's doing to GDP, now, if we look at just quarterly GDP numbers, they've been pretty healthy, except for the first quarter of this year, but that was funky because of trade wars. They've been pretty healthy. So you might think, just by looking at the headline number, well, that means the consumer's pretty healthy. In reality, the blue line here shows you that consumer spending has come down. So all of these expectations about the consumer's driving everything, the consumer is still healthy, everything's fine, they're absorbing the cost, they're spending just as much, if not more, not really true. They're still spending. Now, don't mistake me. I'm not saying the consumer is in real trouble. They are definitely still spending. Retail earnings have been fine. We still have spending and activity going on in the economy. I think that's more about the fact that the consumer still has a job, but consumer spending in reality has come down. What's happened is that the magenta line is AI sensitive private investment. It's made up for what's come down in consumer spending. So just the top line GDP, you're looking at the economy very simply, GDP looks fine. Well, the consumer is weakening, AI spending is picking up the slack. So Guy, to your point, if that investment is not a foregone conclusion, if companies have to change that and consumers continue to pull back, then you've got a GDP problem. So that's what we're looking at here. And that's why when you hear about people talking about the assets being priced for perfection right now, they are priced for perfection. And perfection would be that GDP stays healthy, because where something loses, something else gains, and we manage to make our way through.
Yeah, one thing that I also took away from the Fed minutes the other day was there was a comment about risk assets and valuations and the like. And so, you just used the term price to perfection. And, let's put up that CME FedWatch tool again, just to highlight the fact that this was 90% just a couple days ago or so. And so when you think about that, tomorrow we're going to get some sort of indication, I mean, I can't, it's not like this thing is going to go back to 90 or go down to 50. You know what I mean? Like that would be a shock. That would be a big move. But even if it hangs around here waiting for that jobs data on September 5th and then a bunch of the inflation readings, the fact that it's not a foregone conclusion might be one of the reasons why we've seen that equity market value, volatility over the last couple of days. And I'd be shocked that if we're talking tomorrow at 11:30, if the S&P is up or down 15 basis points, you know what I mean? Mm-hmm. And so to me, that'll be really interesting to see the reaction to something that I think that we've seen a precursor to the fact that they're going to be a bit more hawkish than we think. And it's going to be very data dependent, So thoughts there, Liz, because
I think anything that Powell says tomorrow that does not confirm a cut in September is going to be viewed as hawkish. And some of this move already in the expectations is anticipation of that, because we're hearing from all sorts of people around him that are not confirming a cut in September. I think he's going to buy himself some time. I think he's going to say there's still too much data to watch and nothing is all that convincing that we need to cut in order to support the economy. So I don't think he's going to lock it in. And I think the market will interpret that as at least semi-hawkish. There were questions earlier in the show when we started, what would happen to the S&P if they don't cut? I don't think the S&P is going to wait to move until September 17th if they don't cut. I think there's a lot that's going to happen between now and then. Jackson Hole is one of them. We get a couple more inflation reports in the form of PCE, CPI, and that jobs report. I think the S&P will decide by September 5th whether or not they're going to cut. But the answer to that is if the S&P has to digest the fact that maybe a cut isn't coming, I think down is the answer. It will go down. But there may not be this wholesale shift out of equities. I think the rotation, and this was my point earlier, the rotation sort of stays intact where you've got other sectors, particularly defensive sectors, that might catch a bid in that scenario, but I do not think small caps catch a big bid in that scenario.
So Guy, we talked about a little bit of the rotation. Okay, so if we talk about pharma and we talk about energy, and if they're only rallying right here because of rotation, it's not something you probably want to lead into. If you're a very short-term sort of trader, you might have a ball. You might kind of pick those things off for 3 to 5% or something like that, but they're not going to move the averages, in any meaningful way. And so just to kind of put a bow on this whole conversation and the fine work that you did with CapEx and relative to consumer spending also, I mean, it falls back into the hands of those first 10, or the largest 10 stocks. And, at some point we saw this, I think, at the end of Q1, which happened to be a difficult time, obviously, for the markets because of the trade stuff that was coming out at the time. But, like we did see a deceleration in CapEx. And if we see, like some reason that these companies are suggesting, there was a headline or a story in the FT this morning talking about how Facebook is going to pull back on that hiring spree. Think about how much money they spent for not a whole heck of a lot of employees. Like that was kind of the main point in a way. And so maybe they do digest. They're on their 4th restructuring of their AI business. You know what I mean? So maybe they've kind of been talking about these huge increases over the last few quarters or so, but at some point you're going to get one of these $100 million guys. And sorry, Liz, they're probably all guys who say, hey, listen, we can do more with less. You know what I mean? And maybe that's how they get graded. Guy, we talk about this all the time. When you have new management come into things, there's a whole host of things that they can do to reverse what the prior, group of people were doing. And maybe part of that is to show less spend and get more out of fewer people. You know what I mean? And that's going to be how they're going to be judged going forward.
We're going to find out. I mean, again, the sanctity of this CapEx is something to become. It's not questioned now at all. Maybe for good reason, because so many companies have talked about it. If you listen to Facebook talk about it, how important it is for them to spend, it's hard to believe that they would backtrack on that. But Elizabeth, I know you have thoughts. It does not mean that this is in any way etched in stone.
No, not at all. I just wanted to point out that actually what happened in spring, because we backtracked on those obnoxious tariff amounts quickly enough, there wasn't actually a pullback in CapEx. It was just a pause button. Companies just said, let's just wait and see how this shakes out before we continue promising that to everybody. But I don't think there was a big shift down necessarily where companies said, we're just not going to spend, period. It was a wait and see. And I remember thinking, I was on leave at the time, but I remember thinking and texting with Mario and just saying, if he doesn't come off this soon, it's going to show up and it's going to be permanent, right? This is no longer a negotiation tactic. It's going to turn into permanence because companies can't operate in this environment for very long. And then they came off it soon enough. So, and I think that was a reaction to what had happened in the market, particularly the bond market. So what we could see for the rest of the year is that inflation matters, but also what happens in the bond market is really going to matter for what the Fed does, what the administration pressures the Fed to do.
CC just texted us in our group chat. SPX vol is ticking higher for tomorrow, looking more and more like an FOMC day. Vol for Friday was 13 into this week, now approaching 20. And we've talked about this, Elizabeth. We've said a couple times. You may have heard me say this, but I'm not convinced of anything other than my ability to drain shit from the 3-point line. But with that said, I do think there's a chance that the VIX, you have a 25 print before the end of the month, which, as we're sitting here, we only have about a week and a half or so left. But it just feels as though something is brewing here, Dan.
Yeah,
I didn't know you were a baller, first of all.
Well, come on, stop it. I mean, seriously, you don't know this stuff?
So,
I mean, hold on a second. Really?
Oh my God. Check out his Wikipedia page. It says has an awful lot to say about his football prowess from the
basketball.
We're talking about basketball
from the late 70s, early 80s.
I mean,
he's got some crazy stories for a different podcast as it relates to basketball. But we
know what I used to do, Elizabeth?
Oh no.
I'd find myself on the free throw line this is absolutely true.
Yeah.
And what I would do just to freak out not only my opponents, but my teammates and maybe people in the crowd and maybe the officials, I'd blow my nose in my jersey.
Oh my God. So you've always been like this. This is not.
Yeah. No, nothing's changed.
It's consistency.
All right, so
freak people out a little bit.
So yesterday, Liz, and maybe it's changed just a little bit, but Guy and I were remarking, if you think about tomorrow morning speech, you think about jobs, you think about CPI, you think about PPI, you think about a Fed meeting on September 17th. We were looking at the September 19th expiration. That's a regular way, third Friday of every month. With all of those things going on, now you could say, all right, juxtapose that versus the next week and a half or so. Once Jackson Hole's out of the way, maybe, people just chill the out and they just take the rest of the summer off into Labor Day. But the S&P, the options market was implying a little less than a 3% move in either direction between now and September 19th. The TLT had a very similar implied. Now, you could say the TLT is meant to be at a much lower vol, but the fact that it's similar to the S&P is kind of interesting. And just for some of you folks who just are not that in tune with the options market, if you were taking the implied move, that means you're taking the at-the-money call premium and the put premium, and you put them together, and you divide it by the strike, that's what you get for the implied movement. If you are looking to define your risk and make a bullish bet or a bearish bet, it's actually 1.5%. It just seems really cheap. And I know I just got a little geeked up there, but that's what the options market is suggesting. Guy, I think we've covered a lot of ground. One thing I'll just say, we started with meringue, and it seems like you're meringue. The less you move, the less you're meringue.
Well, that's the way meringue works.
When the three of us are here, I got the whole Johnny Cash thing going. You guys have like a little yin and a yang thing going because you are meringue. Liz has definitely some stuff going on with her shirt. It's a beautiful shirt, by the way, guys.
These are called eyelets.
Just called a blouse.
Well, it's a blouse, but now we did zhuzh earlier in the week. Vocabulary word today. These are called eyelets. These little.
So, Guy, when you and I, we get a little rotund, you know what I mean? A little extra in the midriff section. When you tuck your shirt in, you have to blouse your shirt. Have you ever heard that expression? That's kind of like zhuzhing, but it is kind of like
I don't blouse my shirt.
Really?
You just let it in my pants and
okay. All right.
I'm like the old man. Like when I'm in the bathroom after I take a leak, like I put my pants. No, wait a second. I put my shirt down, and I pull my pants around it, and then
cut his mic.
These are visuals.
Cut my mic. I don't understand.
Guy, in the last 2 minutes, we got to hear how you blow your nose in your jersey. This is late 70s, and now what you do just to get. All right, moving on. So excited about tomorrow morning, Liz. This is kind of like your NFC Championship, maybe. You know what I mean?
Yeah, this is the playoffs. This is like we're getting to the end of the season. Correct. And we're excited to hear what the bracket looks like.
Yeah.
And, we're not sure who the players are going to be for the whole season. I
You never
could
are.
run with this
By the way,
analogy for a while.
since you and I wax.
Oh, he froze. Somebody cut him. Somebody actually did cut him.
Thank you, Jacob. He was going to say, since you guys waxed poetically the week before last, your brew crew has gone on a heck of a. I'm in your head, guy. I knew exactly where you're going.
Yeah, they've fallen on difficult times. I mean, that's baseball, as they say.
Well, they're still in the front seat.
No.
The Cubs did take them for 2 games, and we need to beat the Cubs. So, but yesterday was Burger Day. My dad got a burger. The whole state of Wisconsin got a burger. I hope somebody on here was there.
George Webb's guy. It was George Webb's.
Yep.
We got to get eyes on one of those burgers to see if they look any good. Whether it's like a smash burger, whether it's something from a patty family.
It's like a diner burger. It comes in like a paper,
flame broiled, or are we talking about on the grill? You know what I mean? Like, or I'm
gonna go with a flat top.
Okay.
Yeah.
Like
grill.
Yeah.
All right.
I'm upset that Elizabeth didn't know who Troy Don or even Stockard Channing in the movie Grease. Like that bothers me a little bit.
Well, yeah, I'm just not a movie gal. I'm going to continue to disappoint you on that front.
No, guys, if she was cast in Grease, she would be the Stockard Channing.
She'd be Rizzo.
I think I'd be Rizzo.
Yeah, that's what we just said. We're all in agreement.
Oh, okay.
You'd be a badass Rizzo.
We're aligned.
All right. So
wait, if you're Rizzo, then could I be Kanicki?
Oh my God.
Or no?
So Guy and I, we're gonna do a little
just say yes.
Bed chair Powell little conversation tomorrow. That'll be in your favorite podcast feed. And we have Stu Sopp. You know Stu, he's a good friend of the show. Yeah. He's going to be on with us to talk a little bit about the consumer and what they're seeing from their customers. And we're also going to talk a little macro. So that'll be tomorrow, Guy Adami.
Yes, and I want to give people a little insight. But what do they call it when you knock down the fourth wall or something?
Yeah, you take down the fourth wall.
Yeah. So after these shows, like it goes to blank, and then after about 11 seconds, we come back, and it's typically Dan and I. But in that 11 seconds, Elizabeth will have Audi 5000. Like we won't see her again until the next time we see her. So there's no like after show conversation, which is it's sometimes upsetting, but I get it. You got things to do.
Well, Liz will be on the Risk Reversal podcast with us on Tuesday, Tuesday drop, and we're going to get her take on everything that happened. Also on Friday. Liz, have a great weekend with your islets, with Griff Riv, the whole jam. You know what I mean? And guys, this could be moraying all weekend, whatever that means for Guy Adami, but he's going to be moraying. All right, we'll see you. Bye. Thanks.
Bye.